joining us today for this Talkin Taxes episode. This is actually our second session focusing on Schedule E's. My name is Kiani. I'm a representative at TBP Professional Solutions, and we're happy to be able to bring to you this free webinar on taxes. So, Talkin Taxes is our weekly webinar. We talk about different tips and tricks for tax professionals to be able to help you prepare taxes for your clients. Today's session is going to be on the Schedule E, rental property income, and it's going to be hosted by our president at TBP, Jason Garner. So as I said, Jason's our president here at TBP. He's also an enrolled agent and owner of Garner Tax and Accounting. He has over a decade of experience in the tax industry in all fields, so he's very qualified to present today the information he's going to share. So without further ado, I'd like to go ahead and introduce Jason Garner and have him get started on Talkin' Taxes.
All right. Thank you, Kiani. Thank you for the warm introduction. I am sharing the webcam just because we like to put the personal touch with what we're doing on here. And it just, you know, adds a little bit of more legitimacy to the presentation. So thank you all very much for joining. Thank you, anybody on Facebook Live, for joining as well. So as Kiani said, today we're going to be talking about Schedule E's, well, specifically rental properties and Schedule E's. So the first thing we'll do is we'll take a look, kind of an introductory look at the Schedule E and how it interacts with your tax return. Then we'll specifically want to look at what is residential property and how that's going to look on your tax return. We'll look at personal versus rental expenses because there are some rules, like for example, renting out a room in your house or vacation home that you want to be aware of with discussing with your clients. We'll talk about the types of income and expenses commonly associated with rental properties. Then we'll actually move into the TBP desktop application and show a few examples of rental properties and some of the nice time-saving features. Specifically, and hold on for this one, we're going to look at depreciating properly a rental property without accounting for the cost of land, which typically is not going to be depreciated. We always close up our presentations just with a brief introduction of the suite of products offered by TBP in addition to our desktop tax preparation software and an invitation to join our community. So speaking of TBP, a 10-second little intro about us on this free webinar. We stand for Taxes, Bookkeeping, and Payroll. And our motto is simply to turn offices into year-round revenue machines. I invite you to look at our website, which is simply www.tbppro.com, and to check us out on Facebook, where it's TBP Pro Solutions. We'll start with a quote. 90% of all millionaires become so through owning real estate. And someone who knew a little bit about making money said that, Mr. Andrew Carnegie. So a lot of money to be made in real estate. A lot of people interested in real estate. And it seems lately, even with the COVID pandemic, our housing market has roared back. So a lot of people interested. A lot of you are already seeing a lot of returns with rental properties on the return. And I think we're just going to see more and more. So this is an intro glance at our Schedule C. We've got our Schedule E, please excuse me. Schedule C was last week, and that's on youtube.com if you want to search for TBP Pro on YouTube and see our Schedule C webinar. Our Schedule E is actually supplemental income and loss. So it's actually quite a few different types of income or losses that can be reported. Now, most commonly, it is used for rental real estate, and that's where most of the real estate on that form, what it's dedicated to. The Schedule E also reports royalty, partnership, and S Corp income, and a lot of you have probably seen those already, and estates and trusts. Now, today we'll specifically be looking at page 1 of that Schedule E because we're going to be talking about rental properties, and then, of course, how it interacts with your tax return, how it flows over as a different type of income with some different sets of rules on your 1040, different than wages and Schedule C income, at least. So let's talk about exactly what is a residential rental property. Well, that's going to be something that someone has purchased with the intent on earning rental income with. Some examples are apartments, single houses, condominiums, mobile homes, or vacation home. And we listed 5 examples there. And those are some specific ones that we want to talk about today because, say, like a vacation home or an apartment, if a room is rented, there's going to be some different tax rules that we want to be able to relay to our clients and make sure that they're getting the most from their taxes. So I use those specific examples. But in short, we're looking for dwellings. We're looking for where people live. So that's what we're talking about with residential rental properties, where someone lives as opposed to where someone does work or where someone stores something. A very simple definition that we're starting with, but just want to make sure that we're pointing out that there is a difference between residential and commercial, especially on a tax return. And these are just some of the examples, the most common examples that you're going to see. For example, we get these questions a lot as tax professionals. Well, what if I use the house myself? And a common example when it comes to this is a vacation home. And one of the things that we want to look at is the IRS has some very specific rules and very specific guidelines that we need to follow when it comes to rental versus personal use. Like, let's say, for example, you own a vacation house that you rent it most of the year, but it's your house. You're going to use it for your vacation every year. So the IRS says there's 2 things. If you use it less than 14 days for the whole year, or less than 10% of the total days you rent it out to others, then it's just a rental. We don't have to go in and factor the difference. However, if you're in it more than 14 days or more than 10% of the total days that you rent it, then we're going to have to get the percentage of personal versus rental. Now, this obviously doesn't apply to someone purchasing a house just to rent it to an individual or a family. This is specific to a vacation house. And it's just one of the things that we need to be aware of, because if you have a rental property, and I keep using the term vacation house, it could be any house. If you have a rental property and you live in it more than 14 days or 10% of the time, then you're going to have to get the percentage of personal versus rental, and your indirect expenses, which we'll talk about when we get into the software, are going to be determined by those percentages. Now, vacation is one good example, probably the most common, but another one that you're going to run into is if a family moves out of a house and then they don't sell that house, but they start renting it to someone. Then we're again going to have to look. They probably lived in it more than 14 days. So we're going to have to divide. And really all that is taking the days that it was rented and the days that it was used for personal and getting a percentage. And like I said, we'll talk about that as we move into the software to make sure that we're accurately reporting that and getting the most for our clients. Now, another common thing that we need to be aware of, again, not our simple example of just buying a house and renting that to someone all year. There's actually specific rules for renting a bedroom. So you own a house and someone rents a room from you. Now, the way the IRS looks at that, that's actually rental income. A lot of your clients may forget to tell you that because they think, oh, that's just side money, or that's just help with the mortgage or help with the rent, or it was mortgage actually. So when that comes, in that case, that's actually IRS considers that rental income. They need a Schedule E on their tax return. So if someone owns a property and someone, if they have a roommate that's paying them rent, they need a Schedule E as well. They may not know that. They may not have been filing that. Then guess what? We've got to do a percentage use of rental again, except this time it's not going to be on days personal versus days rented. It's actually going to be on the percentage of the square footage of the house. And what you're literally, they need to do is tell you how many square feet are in that room that is rented and what's the square footage of that entire house. So just a simple example here, a 320 square foot room for a 1,500 square foot home, that comes out to 21.3% of rental uses. So those are two examples. What if someone else is using that house or we're using it as well versus, well, what if I live there myself? And these are just two catches that we want to know, that we want to make sure that we're relaying this to our clients as we're starting work on their return. We're the tax experts and we want to convey that message to them. So they come in and they've got a rental property that they also use, or they lived in a little bit, or they're renting a room to someone else. Boom, we know the first one. That's going to be based on rented days versus personal days. They have renting a room to someone for the whole year. Boom, we know that that is based on the percentage of that area of the total house. Then we start talking about direct and indirect expenses. And I'll show you specifically how this works in the tax software. But let's talk about a few examples. And let's use this one that's on the screen. So we've got 21.3% of rental usage, excuse me. And you're paying a mortgage on this house. So you own a house, you're paying a mortgage, but someone is renting a room from you. Now, let's just simplify the example. Let's say you paid $10,000, and I know that seems like a lot for most people, $10,000 of mortgage interest on that house. One of the things you're going to be able to do is write off as an expense 21.3 or $2,130 of the 10,000 you spent on mortgage interest. So see, these are the indirect expenses. These are the expenses you have anyway. And what the IRS says to do is simply take that square footage, use that same percentage for the price. So that's going to be for like the mortgage interest. That's going to be for like the utilities. That's going to be things that are for the whole house. So to get that accurate expense, you're going to come back and divide it by that amount used. Now there's also direct expenses. And some of you tax professionals are already realizing this looks a lot like the home office deduction that a lot of people used to use a lot. Same formula, percentage square feet of the room versus percentage square foot of the house, and then divide your expenses based on that. However, we're talking about indirect expenses so far. There's also direct expenses. There's a hole in the wall on that room that that person is renting out that is directly just to that room. So that particular expense, that's going to be 100% deductible because that's not for the whole house. That is specifically for the part that is being used for business purposes. So again, these are just a couple of examples to kind of rehash what we've talked about. We talked about these are the different types of rental properties that our clients are going to bring us: apartment, condo, vacation home, mobile home, whatever it may be. And for the most part, if they're just renting out a single house to someone, that's income minus expenses. We'll talk about that. Just wanted you to be aware of two important distinctions that the IRS, or calculations, if you will. And we want to make sure that we know the rental versus personal use. Anything over 14 days or 10% of the total days that you rent it, we've got to get the percentage of personal versus rental. Anything that you're sharing with someone, you live there too, and they're renting a room for you, we've got to get the percentage of the rented usage. And we're going to use those percentages in the software to show you how to accurately track this. The types of income when it comes to having these rental properties. For examples here, obviously, and this is the one that everybody thinks of immediately, is the normal rent payments. You charge them $1,500 a month for a dwelling, $800 a month for a room. That's your rent payment. Also, most taxpayers, overwhelming majority of individual taxpayers, are going to be cash basis taxpayers. So advance rent payments. So if somebody pays you for a couple of months in advance in December, they pay you January, February rent. Guess what? You're counting that rent for that prior year. That's an advance rent payment. You're a cash basis taxpayer. That's income for that year. Don't have to count it for next year, but you do for this year. Payments for canceling a lease, that's built into a lot of contracts. Someone needs to get out of a 12-month lease early. There's typically some type of payment or penalty that is typically reflected as income. And something that also a lot of people don't consider, expenses paid by the tenant. Now, what a lot of tenants will do if there's a repair made to a house, they'll call their landlord and get it fixed. Obviously, those are expenses, probably repairs that you're going to count in that current year. However, if the tenant pays out of pocket to get that fixed, that is either going to be deducted from their rent, and there's actually a lot of state laws that say you have to do that. But if it's not, that's got to be counted as income as well because you're not the one paying to get your property fixed. So that's four examples of what's going to be included as income on this particular return. Types of expenses: ordinary and necessary expenses. So these are things that you're spending within that year that you need to spend in order to continue your profit for that particular, or your ability to continue to make profit on that rental property. So like we said earlier, if you have a mortgage on that house that you're renting out, you're probably paying interest. That is an expense. If you own a property, you're paying property taxes. That's going to be expense. If you're taking out an ad to rent that property, that's an expense. If you are driving back and forth to that property from your tax home, which we talked about in our vehicle expenses webinar, which is also on YouTube, if you want to check that out, that is going to be an expense probably at the standard mileage rate. And you actually could do actual versus standard mileage. Or if you got to fix anything, those are some expenses. And we're going to see those actually listed in our example return today. Now, another one that sometimes is overlooked, especially with a lot of first-time renters or a lot of side job or do-it-yourself, is depreciation. And depreciation can really be a hot topic with some clients. When you turn a property into a rental property, that could be upon purchase if that's your intent the whole time. It could be when you move out of a house and decide to start renting it. At that point, you're looking to make rental income. So that is a rental asset that you're using. So that particular dwelling is actually subject to depreciation. Now, depreciation, again, we did another informational webinar on depreciation, is simply taking the total cost of that building and dividing it over a set number of years. And when it comes to residential rental property, it's just a flat rate. So it's an easy calculation. So if you spend $100,000 on a business and it's a 30-year asset, I think it's 30 or 27.5. We have that a little bit further. You're going to divide it by the number of years, and you're going to take that deduction every year. That's going to help you with your taxes in that current year. However, when you depreciate a building, and a lot of people don't realize this until they sell that rental property later on, every year that you could have taken that depreciation deducts against your basis in the home. That means there's a lot of people when they sell rental properties, they're surprised with a tax bill. So to give you an example, if you buy a house that's $100,000 and you're depreciating that for $5,000 a year for 5 years, and then you turn around and sell it for $90,000. At first glance, and probably what your taxpayer is going to come in and say is, I got a $10,000 loss. And they're expecting that to really help them with their taxes. And actually, what are you going to tell them? Well, 100,000 minus 5,000 per year for 5 years is your basis is 75,000. So you actually sold it for 90,000. You actually have a $15,000 gain. So they go from thinking they have a $10,000 loss to a $15,000 gain. That requires some explanation on your part. And you want to be ready for that when they come in. I've done a few, I do taxes myself, and did one of these a couple of years ago, and I had to call them and tell them, and of course they're shocked and wondering if it's done right, and basically have to go through and explain a concept that not a lot of people understand to begin with. So keep that in mind when it comes to that depreciation of that rental property. That could hurt a few years down the road. Then you've got repairs versus improvements, and there's actually it can be some gray area in the middle. But however they're classified, they're treated completely different. So repairs are typically an expense. So an expense, that's what we're going to use for that year. So like if I spend $1,000 fixing the kitchen cabinets, I got $1,000 deduction for that year. However, if I come in and just improve the house, if I just decide to remodel, spend $3,000 on cabinets, that's probably either going to be added to the basis of that particular rental property, or I'm going to depreciate over a certain number of years that particular improvement. So there is a big distinction between the two. As tax professionals, just want to make sure when we're dealing with rental properties that we're able to talk the talk, if you will. That when they come in and they tell us, I've got a rental property that I've sold, that we know exactly what we need to start explaining. Or if they've done a big remodel or a new roof and they're expecting to have a big write-off for that year. Or letting them know, yes, if you drove back and forth between your rental property, yeah, we're going to count that mileage. Or if you paid taxes on it or took out an ad to get it rented, yeah, we're taking that expense, and that's going to help you with your taxes. Just being able to talk the talk with this goes a long way because we're in a professional service business. So they're not coming to us for things that we're building or producing. They're coming to us for what we can do. And when we can do for them is help them get the most out of their taxes and help them avoid any potential pitfalls with the IRS, that's when they keep coming back to us. So let's say we had a loss on a rental property. I bought it. I had to make repairs. I had to pay taxes. I only rented it for 3 months. So I've got $7,500 loss on my rental property. Can I count my loss? So I'm coming into you, my tax professional. Here's what I did. Can I count this? Well, the answer with most tax questions, maybe. And a lot of people, they can, because rental activities are considered passive income or loss, and there's limits that are based on that. So basically, up to $25,000 loss can be deducted if your income is less than $100,000. So anybody making less than $100,000, they can write off up to a $25,000 loss on their taxes. And that can be a big help on a tax return for a lot of people. Now, as they start to make more than 100,000, that $25,000 shrinks is what happens and will completely phase out for high income earners. So I'm at a loss on my rental property. Can I count it? Maybe. Let's see how much other money you made before I answer that. Because what we don't want to do is say, yeah, of course we're counting that loss, and then find out they made $200,000, $250,000 in their other job or income. And well, we're not counting it at that point. Now there is a caveat to that, a loophole, if you will, not really a loophole, but just the way the tax law is written. Real estate professionals can write off more than the 25,000 and get away from the income phase out. But they really need to be a real estate professional. The IRS has specific guidelines on who is a real estate professional. So the majority of your time spent is on your rental property trying to earn an income. So that means you got to spend more time buying, fixing up, advertising, cleaning rentals than you do on any other work for that entire year. Or if you just dedicate 750 hours, which that comes out, I think, around 30 hours a week or something like that. So you got to put a lot of time into that and be careful using that real estate professional. We want to make sure if we're using that, that's certainly merited, because we just don't want to get that letter later on and explain that we probably should not have counted that deduction. So with that being said, I do want to pause, see if we have any questions at this point before moving into the tax preparation software and actually preparing a Schedule E for a rental property.
Feel free to unmute your mics or write in the chat, and we'll be able to answer your questions.
Also a Q&A feature built in as well. Looks like we have a great turnout today. I definitely wanted to say everyone appreciate you coming in. So I'm going to go ahead and get started. If I see the chat pop up, I'll just pause and we are going to go ahead and move into a Schedule E and TBP Desktop Pro. Went ahead just for you guys. Thank you for joining and created a new tax return in TBP Pro Desktop with okay, so 2 questions coming in. Please restate your depreciation example when preparing the return, and can we redo the depreciation recapture example? So that's pretty much the same question. How about we just do it in the software? And that might make it a little bit clearer. I'll be talking to it less, and we'll actually just show you as we move through. So let's go ahead and start, because I went ahead and started a return, just named it Jason Rental and filled in some basics for you. And the way the TBP Pro desktop software works is to add a Schedule E. We simply go up to Add Form, and we just type E in our form box, or just double click on the E, either one. In this case, I already have our Schedule E added. And we will do depreciation in here and talk about the recapture as well. So I will address both of those questions coming up. So let's talk about this for a second. The Schedule E allows us to enter up to 3 properties on the first page. And guess what? If you need more, we just simply add another Schedule E. And then we'll have 2 in our forms list on the left. So looking at this, I went through with a couple of examples. I did 123 Full Year Street, and that's going to be a rental house that we bought and we rented all year. I did Just a Room Street, and that is one where we're going to look at dividing the square footage on that. And we also did Vacation Home, where we're going to talk about business days versus personal use. So we're going to look at these 3 specific examples and make sure that you're ready. First one we're going to look at is 123 Full Year Street. Notice that we have that in section A for part 1. So we are listing the rental property here, simply the address. The full year street is just something I did to keep track of which one is which. We have a property type that can be selected from our choices. In this case, we have a single family resident. You can also pick multi-family, vacation, or commercial. Picking this, and I'm putting that it was 365 days rented. Now, this is part A on this particular return. So if I scroll down, notice I have column A. So column A is going to be dedicated to the property that I have on 123 Full Year Street. So the very first box, I've put a $5,000 amount for the rents received. Please note that there's also a dark gray. And if you've used TBP Desktop before, you know that light blue, that's you, dark gray, stay away. That's a calculated field. What a lot of people with rental properties, especially if they're using a property manager, they may get a 1099 in the mail. And when we get those, we're going to go to Add Form. We're going to find our 1099s by typing that in. And I'm going to pull up the 1099 miscellaneous, because on box 1 is a box for rents, in which we enter an amount. And then please notice the box to the right, linked to the 1040 schedule CERL. So you can probably fill in what we're going to do here. So if someone gets a 1099 for their rental income, remember that 1099 has been filed with Social Security and the IRS. So the IRS wants to see that on the tax return. So we're not just going to disregard it and put the amount in. We're going to actually also load this 1099 with this EIN or Social Security number, and we're going to link it to my Schedule E just for this box here, just by clicking on Choices. Then if I go back to my Schedule E, notice that it's pulled that $1,000 into that box and totaled it to give me $6,000 in rents received. So just keep in mind, they get that 1099, we want that in the return. A lot of times there's not a 1099. We're just typing in that light blue box. Now from here, the Schedule E is a lot like an income statement. And what I mean by that is we've got our income at the top, and now we're just going to start typing in what our expenses were. We spent $100 on advertising. Please notice the real-time calculations. As soon as we type in 100, gives us our 100 for total expenses, gives us our income or loss. Taking that 100 out of the 6,000. Cleaning fees, and I won't spend a lot of time on here because this is just entering these expenses, hopefully pre-totaled for you. If not, you're going to do the totaling. Piece of advice, you also have a nice functionality in the software to press Control W. And this will allow you to break down a particular box. Like if you wanted to say, for example, legal and professional fees, press Control W. Some of them were legal. Some of them were professional, just making generic examples. You can list those out specifically like that, and they'll total into the box for you. Notice when we come down to line 18A, depreciation expense, that's going to be another dark blue field. So that means we're not going to type in that depreciation. So we're going to go ahead and jump into how that works in TBP Pro Desktop. We're going to use a keyboard shortcut to press Control N as in new. And all that's doing is the same as clicking on Add Form and clicking on Depreciation. That's going to allow us to select our Schedule E and specifically that property that we're depreciating. So that takes us to our business activity list, in which we don't have any listed. We're simply going to click New Asset. I like to enter the address or the street address for the description. We need our date placed in service, which is simply just entering the date in which they started renting the property or started attempting to rent the property. And we're going to find residential rental properties. And there it is, 27 and a half years for our asset class code. So the software is going to allow you to select these. And these are straight from the recommended IRS or required IRS depreciation schedules. So this is going to tell us the year and the method, straight line being the simplest, easiest to calculate and explain too. So we're going to select residential rental property. Now, what we're going to do in TBP Pro Desktop is we're going to enter the total value of that home where it comes to original cost or basis. However, typical rule of thumb, when it comes to depreciation and land doesn't lose its value. And that's really true in a free market sense and from a tax law sense. So when it comes to the land, we'd actually need to put that where it says salvage value. That's part that we're not going to depreciate, that we're always going to have. We're always going to have that land value as long as we own that particular asset. Now, what I typically do when preparing returns here is, you may be saying, well, how do I know what the land is worth versus what the house is worth? Most counties in the United States now allow you to look up tax records online. So for example, I live in Bartow County, Georgia. I type in Bartow County tax records on Google or another search engine. I usually find the free public information system that allows you to see the taxes and owner of each individual property in your county. And they will typically go through and list the total value and the land value. In this case, I'm going to assume that it's 20,000. And that's technically all I need to do to depreciate this asset. Notice that it's came in, it's take my basis, it removes the 20,000 for the land value, and it depreciates the rest, which is 4,182. So what that number is 120,000, remember, minus the land value, divided by 27.5. That means every year for 27 and a half years that I rent this property, I automatically get a $4,182 deduction on my tax return. I am depreciating the rental property as it moves through. Now, Let's talk about this a little bit more because every year that I depreciate that particular rental property, that takes away from the basis of my rental property. And that should address the two questions that we got in talking about the depreciation recapture. So let's talk about that a little bit. Let's go back. Let's press Control N. Let's go to my 123 Full Year Street. Let's look at my rental property here, 123 Rental Street. Now what I'm going to do is I'm going to change the date. I am going to say that I started depreciating this property back in 2010. Software is automatically going to make these calculations for me. And if I click on the depreciation tab at the top, I'm going to be able to see these real-time calculations. See, notice my starting depreciable basis is $140,000 value minus the land value, or $120,000. I'm dividing it over 27.5 years. But notice, because I've already rented it for 9 years, software is calculating, hey, you should have already deducted in depreciation $39,000 for this particular house. So your tax basis now is $80,907. I'm going to go ahead and close this. Notice my depreciation for this current year is still the same number. But now, if I go back in, because a lot of people, especially if they're like on a TurboTax or been doing their taxes themselves, there's a large number of people that did not take that depreciation expense on their tax return. So that $39,000, they don't know about it. So let's go back to this particular example. Since I've been depreciating, or should have been, and that's a key there, should have been, IRS still adjusts your basis, even if you were not taking the depreciation on your return, in which case you're probably going to go back and amend some returns, but your basis is now 80,907 because you should have been depreciating for those 9 years. So now if I were to sell this asset, and I can actually, in this software, click on sale, say that I sold it this current year, and I sold it for $90,000. This, let me make sure I got this, 90,000. Looks like we're good here. Hang on, I think I missed a click. Give me 1 second. That's what happens when you go live, right? I think we need to do an ordinary for 4797 is what we need to do on this. There we go. What that's going to do is automatically load this particular form for us. And they're expecting a $50,000 loss because they paid $140,000 on this particular tax return, or on this property, please excuse me. It's actually just a $10,000 loss. And to make this example hit a little bit further on, more like the original one, let's say that they did sell it for $120,000, a little bit more like the example we were talking about. Now, when we do this, they paid $140,000 for the house. They sold it for $120,000. They're expecting a $20,000 loss. They actually have a $19,000 gain. But notice, just by clicking that sale button, how the software takes care of most of those calculations for you. So hopefully, if we take a timeout for a second, going back, hopefully that should address those two questions that we got in, talking about the depreciation. We could probably talk all day on that one, but just want to make sure that we got those particular ones knocked out.
We do have one more question, Jason. Luther said, is the recapture need to be done only if depreciation was taken each year?
I know, Luther. Thanks for joining us again. I think you were with us last week for Schedule Cs. And it is my understanding that yes, it does. So I was actually doing a tax return earlier this year. Person had a rental property. They sold it. They had not taken the depreciation expense all those years. So we actually went back and it wasn't amended return, it was a change in basis form that we had to send along with that. But we essentially went back and counted all that depreciation and we were able to count it in that current tax year and then amend that current return. So my understanding is you want to take the depreciation because if you've moved it to a rental property, the IRS assumes you're taking the depreciation and it's going to adjust your basis whether you've listed it on your tax return or not. I got a wow out of that one. I've got the wow out of that one before, but good question. Yeah, good question. Because there will be some people you're going to go back and amend those, and that is like a change in basis form that you got to do. I've done one of those before. It's one of those. If you Google it, it says go hire a lawyer or a CPA. So we can certainly help you out with them though if need be. But yeah, let's continue talking about this. I don't want to run out of time. Let's go back to the Schedule E that we're talking about. And let's look at our other examples. Let me minimize my window here. If we did the just a room here, with the just a room, so we're renting one room in the house that we're already living in. So remember, we can't come in and take all the expenses, but based on the square footage of that room, we can take partials. Now, the way TBP Pro Desktop does this is actually through our pro forma forms. And you see how they loaded automatically. They're on the bottom left. If I click on this, this is going to allow me to come in and put my indirect expenses versus my direct expenses. So notice if I was advertising to rent this room out, probably going to be a direct. Things like insurance, mortgage interest, everything like that, those are going to be indirect expenses, in which I'm only going to be able to take that percentage of those is what I'm going to be able to do. There's my percentage. And that's based on the square footage of the house. And now you can see instead of 4,000, I'm only counting 22% of that. So I've got my direct and I've got my indirect. So because of this particular form, I can go in and just enter the information as it occurs. Let's say 4,000 on taxes as well. Notice it's going to take that by that percentage. Then if I go back to my Schedule E, my $40 advertising is listed as a $40 expense. That was direct to renting that room, but my mortgage interest and my taxes are only $880 because those are determined by the percentage of the room rented. Something that we want to keep in mind. And there's a lot of people out there that are renting a room to a friend, not getting a lot of money on that particular room. So they paid like $2,000 in rent all year. They could come through, and if they're tracking their expenses and utilities and everything like that, be able to produce a nice little loss on their taxes to help with their refund. Just something to keep in mind. Thing is, they need to be reporting it anyway. The last one, see the 22% here as well, carried over, is our vacation home. And we actually can handle those calculations here where it says number of days rented versus personal use. Now, remember our rule, 14 days or less than 10% of the time. In this case, with my 5 days of personal use, I'm fine. But if I come in and bump this up to 16, well, it's got to be a total of 365, excuse me. Let's do 340 and 15. That's going to change some rules on here. Then, as I'm entering the information on here, I want to be able to use my pro forma forms again. These are real important how these work on the bottom left for the vacation. And notice how it's already calculated my percent of tenant occupancy. So almost all of these expenses are going to be indirect or direct. That's where I'm going to fill these in. I spent $400 trying to advertise it out. That would be more direct, excuse me. But since I used it myself, something like the taxes that I paid on this particular, I'm not counting what I used for myself. So let's think about that calculation for a second. That beach house or that vacation house, if I was there 15 days out of the year, that's not 5% of the time I used it personally. That's 95.77% of the time that it was rented to make money. The taxes I paid on that are only deductible to that 95%. I don't get to count the 5% that I was there. So to kind of summarize, these pro forma columns are very good at doing this calculation for you with the indirect versus the direct. And then if you look at your Schedule E, see how I've got these automatically calculated for me and placed in here to begin with. Now, this, like I said earlier, is like a running income statement. So any of the income that I'm entering in the top is going to have the expenses totaled and deducted. And there's my deductible income or loss for each one of these. If one of these was a loss, I'm just going to change this to 3,000. Just going to total for us and give us a net amount of what we made on all three of the rentals. So the loss on this one takes away from the gain on the other two. Now, this number, my net income here, this 2,923, is actually going to be carried to a Schedule 1, which you're going to see it on line 5, rents, royalties, partnerships, escorts, etc. Then that's going to move to my 1040, which is giving me the total for my Schedule 1. And notice we're not getting dinged or hit with self-employment tax on the rental properties. Nice little way the tax law is written. No self-employment tax on that. Of course, unless we're a real estate professional, but we talked about that already as well. So what I'll do right now is we are about to start wrapping things up. I'll see if we have any other questions before we move on.
Hey Jason, I don't see anything in the chat. I do
Is
have
there
one in the
also an
Q&A.
interview version of this? There is an interview for the tax return. Quite frankly, I haven't really gone through what it does on the rental properties. I love the interview for the more simple returns and the data entry. For the rental properties, there is an interview. I did that by clicking the interview button here. I'm probably looking straight at this. Owned rentals, there we go. And as you go through this, clicking the next button, it's going to load particular ones for you. And if I look at the interview, now that I've answered there, it's essentially going to load real estate. And then that is basically a lot like the Schedule E itself. So while there is an interview, it looks like it's probably a little bit more efficient just to go straight to the forms when it comes to that. Qualified business income from rental net income. So qualified business income deduction. That is a bear of a topic. I think the IRS has released 2, 3, or 4 clarifications since they rolled that out. And it's my understanding one of the clarifications said, yes, qualified business income deduction does count for rental properties. So that is a deduction on that income that you can use to help out with taxes on that. Good question. So without further ado, if there's a few more questions coming in, we'll take those as they arrive. I don't want to get us too short on time. I do want to show you some resources that you could use, and these are what I use for these presentations, and they always start with www.irs.gov. IRS has done a wonderful job with their website as of late, getting clear, concise, searchable information. Specifically, I looked at the instructions that I found this particular link here. Also, publication 527 for residential rental property. And there's a small business site dedicated just to rental income and expenses and real estate tax tips. So some great resources. Again, this is going to be recorded, put on YouTube, so you can come back to these and see these. And obviously, if you want to reach out to us, we'd be glad to email you these resources as well. We looked at our desktop application today, and that's TBP Desktop 1040. We do proudly offer that to anyone that wants to take a look. With text marketing capabilities, you saw all the powerful features when it came to Schedule E's, depreciation recapture, how simple it made that. Remote signatures, built-in due diligence, built-in document management, multi-office setup, even for a desktop application. And if you're doing the bank product returns, we've got some great deals that we'll discuss with you. TBP takes it to the next level with our bookkeeping and payroll packages. If you're looking to branch into this or already have and want to look at how we do it as well, you can offer bookkeeping and payroll in just a few days. Earn monthly, year-round revenue, 100% supported by us with all software provided. We even provide a client management system, 100% online, that we refer to as SmartNet. That is basically used for our bookkeeping and payroll services, but is a very nice client management system for your tax customers as well. To help get you ready for the first COVID-19 tax season, where you're going to have a lot of people that still want their taxes done but don't want to go into a busy office, we have a custom-made mobile app different than the competition. Our mobile app directly from the App Store, and this is one of our clients, is branded to your business name. There's no barcode to scan. There's no hoops to jump through. They see that. You build your brand with your app being your name and your app being on the App Store. Your client, you can schedule live meetings, so you can do like I'm doing, face-to-face, show them your screen, and even take payments with our mobile app. That's our presentation today. We'll go back and see if there were any other questions coming in. We always end our informational webinars with just an invitation to join TBP, to definitely get some more information about us if you want to, www.tbppro.com.